Ladies and gentlemen, good day and welcome to Sansera Engineering Limited Q3 FY24 earnings conference call. This conference call may contain forward-looking statements about the company which are based on the beliefs, opinions and expectations of the company as on date of this call. These statements are not guarantees of future performance and involve risks and uncertainties that are difficult to predict. As a reminder, all participant lines will be in the listen-only mode and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star, then 0 on a touch-tone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Pritham, CEO and Executive Director. Thank you and over to you, sir.
Thank you. Good morning and welcome, and thanks for joining this call. On this call, I'm joined by our CFO, Mr. Vikas Goyal, our COO, Mr. Praveen Chauhan, and our Investor Relations Advisor team from SGA. The results and the presentations are uploaded on the stock exchange and the company website. I hope everybody has had a chance to look at them. FY24 has been a fairly strong year for us. We delivered our highest ever performance in terms of sales as well as EBITDA in each of the quarter in this year. India continues to be the third largest automotive market globally. The auto industry is expected to drive major manufacturing growth and become a major exporter of cars as well as auto components. The auto component industry itself is witnessing a lot of traction and growth due to increased opportunity as the content supplied to the OEMs has been on a continuous increasing trend. Sansera has also been the beneficiary of that. India has become an integral part of the global supply chain. Globally, OEMs have a renewed focus on all the ICE platforms as well, apart from their focus on the EV segment. And they are extending various ICE programs beyond 2032. Similarly, aerospace and defense OEMs are also actively looking to expand vendor base in India with a target aiming to develop a sourcing and a manufacturing base for the long term. From time to time, our achievements are recognized by our customers. Recently, Honda Motors India awarded us the target accomplished in delivery and quality during year 23-24. Now, coming to our company's specific performance highlights for the quarter gone by, we are pleased to announce that we have reported strong financial and operational performance in Q3. Our revenues came in at a healthy rupees 7,126 million, representing 27% year-on-year growth and a 3% sequential growth. EBITDA margins during the quarter were steady at 16.9%. The performance is particularly noteworthy as this strong performance came through despite Q3 being a slow quarter industry-wide and the pressure that we are seeing in our subsidiary in Sweden. This quarter, we saw good order execution on international business as expected, which comes in with obviously a higher margin. This increase in international business has mainly come from our North American customers. Now getting to the details of our operating performance in the quarter, the Auto ICE segment registered a 28% year-on-year growth for Q3 FY24 and a 16.4 year-on-year for 9 months ended FY24. This growth was primarily driven by growth in our PV and two-wheeler motorcycle segments. In fact, within the two-wheeler components, we had our highest ever quarterly sales driven by the motorcycle components, which is also helped by the premiumization of these models which have started delivering the numbers. And this upsurge is also backed by the strong performance of our large two-wheeler customers along with an increase in share of business focused on premium models. We are participating in most of the premium motorcycle models, including Royal Enfield, TVS, BMW programs, Harley Hero models, and Triumph Bajaj models as well. Parallelly, the CV segment, which contributes more than 10% to the total sales, has also witnessed the highest ever sales in this quarter. The PV segment contributed 22% of the sales in this quarter, which is a 36% improvement over the same period last year. We are focusing on increasing our wallet share among our customers and targeting to participate in their newly launched upcoming models as well. In all, the auto segment contributed 76.1% of our sales in Q3 FY24. This segment includes 37.1% of the sales from motorcycle segment. Scooters accounted for around 5.7% of the total top line. Passenger vehicles accounted for 21.9% of the top line. Commercial vehicle sales contributed to 10.7% of the top line. As anticipated, the other segments, which are auto tech agnostic, XEV and non-auto, have also grown at a faster rate. Auto tech agnostic and XEV products together contributed to 11.7% to the sales revenue, reflecting Sansera's readiness for the futuristic product range. The year-over-year growth in the first 9 months of this financial year was an impressive 41.8%, demonstrating exceptional progress. 7.9% of the revenue came from auto tech agnostic components. We have very good traction for our aluminum components due to the growing requirements of the lightweighting, as well as the fact that more aluminum components go into the premium models. The contribution from XEV products has decreased to 3.8%, primarily due to the scaling down of our business from one of our domestic EV two-wheeler customers, as mentioned previously as well. However, our EV business will improve as our new American multinational automotive EV customers' orders have already started contributing to our top line. Our non-automotive segment grew by 25.5% in the quarter, contributing to 12.2% of our total sales. And the contribution was similar in Q3 last year. Talking about the sales mix, in aerospace, we manufacture seating parts, aerostructure parts, door assemblies, lighting parts, cargo handling systems, parts which goes to actuation and engine systems. Aerospace and defense contributed together about 4.4% to the quarter. Growth in this segment is lower than our earlier expectation, as there are some delays in one large order from our customer's end, which was also mentioned during our last conversation. This order is expected to be starting from this quarter, but ramp-up will happen throughout the next financial year. Off-road sales were to the tune of 4.6% of our revenue. This year, we expect to achieve a top line of more than rupees 1,000 million in the off-road category. Agriculture accounted for about 1.6% of the top line, and the remaining 1.6% of the top line came from few other segments. Our order book of the new business with an annual peak revenue stood at rupees 20.4 billion as of December 31st. This is more than 85% of our top line in the last year. This is a very meaningful number, as this is over and above our existing business and does not include the orders which are already in the mass production stage. In the quarter, we saw a very strong inflow of orders in both non-auto segment and the auto segment, reflecting Sansera's expertise in these areas. Non-auto accounted for almost 58% of the new orders, and we also received major orders from tech agnostic products, which accounted for almost 14% of our new incremental orders in the quarter. On the CAPEX front, this quarter, we have finished the construction of our new machining facility at our existing plant level. We have already started commissioning machining lines here, which will primarily cater to the machining of aluminum forged and forged components, as well as bigger connecting rods for agriculture and construction equipment and heavier engines as well. The construction of the new forging plant at our Bidadi facility has commenced, and we expect that towards the end of the second quarter of the next financial year, this building will be ready, and we will be commissioning our 4,000-ton press in the same new building. This will be very meaningful. This will also be a very meaningful addition to the progress in our lightweighting and aluminium components. I now hand it over to Vikas Goel, our CFO.
Thank you, Preetham. Good morning, everyone. I will talk about the consolidated financial performance for the third quarter of FY24. Our revenue stood at rupees 7,126 million, with a 27% growth on a year-on-year basis. This is a very broad-based growth across the geographies and segments. Over the years, Sansera has become known as a leader in the connecting rod space, which is very critical in auto ICE. However, a number of our ICE products, including the connecting rods, find application in both ICE as well as non-auto and tech-agnostic spaces. We have increased our disclosure with respect to the component mix to offer more clarity on this. You can refer to slide number 17 in the presentation for the same. Further, in terms of revenue mix, customer diversification is in the place. With higher business coming in from new customers, the percentage of top 5 customers came down to 48% from 52% on a year-on-year basis, which is a progress in the right direction. Gross margins were in line with previous quarters. However, 1 percentage point improvement in EBITDA margin is witnessed, which is largely due to operating leverage coming into play. Overall, EBITDA improved 36% on a year-on-year basis to rupees 1,207 million. The finance cost for the quarter was at rupees 175.4 million, which was in line with the finance cost of the last quarter. Profit after tax of 483 million for the quarter with a margin of 6.8% witnessed a year-on-year growth of 55%. Geographical sales mix for Q3 stands as follows: India 68.3%, Europe 18.1%, North America 11%, and other foreign countries 2.6% of the total revenues. Now we come to the 9 months performance on a year-to-date basis. Revenue from operations surged by 20% year-over-year at rupees 20,656 million, as compared to rupees 17,274 million in the corresponding period last year. 9-month EBITDA grew in line with our revenues and stood at rupees 3,582 million with a margin of 17.1%. Net profit for the 9 months at rupees 1,412 million registered a growth of 25%. On the debt front, our net debt stood close to rupees 6,196 million. With this, we conclude the formal presentation and open the floor for question and answers. Thank you.
Thank you very much. We will now begin the question and answer session. Participants present on the audio bridge who wish to ask a question may press star and 1 on the touchtone telephone. If you wish to remove yourself from question queue, you may press star and 2. Ladies and gentlemen, we'll wait for the moment while the question queue assembles. And the first question is from the line of Siddharth Bera from Nuvama. Please go ahead.
Yeah, thanks, sir. Thanks for the opportunity and congrats on a good set of numbers. Sir, first on this order book, we have continued to see a very good improvement over the year in terms of the order book. Can you, depending on the order book now, can you give some more color about what percentage or what quantum of this order book will probably get executed in the next 1 year? And according to you, which segments do you see stronger growth? I mean, this quarter we have seen a good pickup in the two-wheeler motorcycle segment. But if we look for the coming year, which are the segments which you think that growth can be stronger depending upon the order books that you have?
Thank you. Thank you, sir. So Orders, as I said that Indian auto comp industry has been witnessing quite a steady inflow of orders, and we are no exception. While we have diversified into non-automotive and in automotive tech agnostic components, XEV components. So these are helping us definitely to increase our order book. So currently, what we are seeing is that most of this orders, the maturity would happen around FY27. So which means that from FY25 to FY26 and FY27, towards the end of FY27, the full maturity of this order book could be seen. That's what we have the projections from our customers. And if I have to speak about from which sectors are we getting the maximum traction? So out of the total order book, about 47% of our orders have come from auto ICE. Non-auto contributes to about 23%, XEV about 18%, and tech agnostic components about 12%. In auto ICE as well, I would say 28% is coming from passenger vehicle segment, and in two-wheelers we see a lot of traction on the premium motorcycle segment. So that is where all our growth is coming from. We have added also some customers in the larger engine capacity, so I see a lot of growth coming in that segment, which goes into industrial, heavy commercial vehicles, then agriculture segment. Of course, our XEV components continues to grow. We have kept adding to this as well.
Okay, sir. Just to some more clarity on the non-auto side, we have sort of overall numbers been around that in the last couple of quarters. So some color on the outlook, like aerospace or off-road, can we sort of go back to that 40-50% growth which we sometimes have indicated in the past in the coming year, or that according to you may take longer?
No, I think, we still, fundamentally, there is a good traction in the non-auto segment. We have been growing. You would see you would see further addition to this segment in the coming years as well. As I said that we have picked up orders on the larger engine category, which is mostly non-automotive. Second thing is that on the aerospace and defense, we continues to see a good traction. Of course, there were some delays in few of the orders execution as I had communicated last year. Otherwise, we would have seen the same number, same 45 to 50% growth this year, but for that. But slowly we are seeing that is also coming back, while almost 70-80% of that order will be executed in the next financial year. We see still, as we see today, the current customer projections and the order pipeline and the development pipeline that we have, we still think that next year we could see closer to 45 to 50% growth in our aerospace and defense segments. We continue to be quite positive on this segment, Siddharth.
Got it, sir. So last question on the margin side. If I look at the standalone margins, they have improved quite a bit. If I look at Q2 versus Q3, but we have not seen that type of improvement in the Concall margins. So any color why you mentioned like Sweden had seen some issues. So probably X of Sweden, where will be the margins, and how long do you think this Sweden issue will take to resolve? By when should we see the normal margins coming back X of Sweden?
So there has been, Europe, we see a bit of a slowdown overall, as well as due to the reorganizing of the product share of business between us and another supplier for the de-risking. there is a cut in share of business on our largest engine program, but we have got additional volumes from the other programs, but that is not in line with, in the sense that because we have two separate lines, one producing larger volumes where we have lost some share of business, and overall volumes have come down in this segment as well. So we have see the whole of the next year, the Europe looks flattish, and then we don't see too much of a change coming from the numbers that have been projected from our customers. So what we have done is, we have, based on what projections that we have started serious conversations with our existing customers for finding a solution, because we don't intend to, or on a long term, this is not a desired situation for us to have in Sweden. So we have taken up with our customer for various options, including looking at some of the production facilities to be, or some of the volumes to be done from India to offset the cost, or compensating. So it is underway. Discussions are underway. So I don't see too much of a change that is happening in Sweden in the coming quarters, unless there is a market pickup or change in share of business that can happen. But we are in continuous conversation now with our customers to ensure that how do we cover up for this reduction in margins. Of course, our other subsidiary, Fitwel, we have a very strong product pipeline, sales pipeline there. This year, due to one of the customers' slowdown for them, the growth has not been significant. They have had a single-digit growth, but then their order pipeline is quite strong. So I expect that next year they will have a reasonably higher growth for us. So on a standalone performance, Vikas, can you talk about it?
So we have done well, as you also noted, Siddharth, on the standalone basis, and and it's on all the fronts, including gross margin as well as on the operating leverage in terms of other costs. So that is translating well, and if we had been able to maintain the same historical rate in the subsidiaries, we probably would have a margin which would be higher by about 0.5% or 50 basis points. So that's the impact that we see. While Sweden may take a little longer to resolve, in Fitwel we are hopeful that we will recover faster. And the impact itself is very low there.
Got it, sir. Thanks a lot. I'll come back in the queue.
Thank you. The next question is from the line of Akshay Karwa from Anand Rathi. Please go ahead.
Hi, good morning, team. Thank you so much for the opportunity. So firstly, congratulations on good set of numbers, and despite Q3 being a sluggish quarter for the industry, we had good numbers. So just one, forwarding the previous participant's question on the order book. So assuming that the 2 billion order is executed by F27, what type of revenue are you targeting? Something around 4,500 crores of revenue or top line. Could you talk about that, sir?
Actually, could you repeat? I could not hear it clearly.
Okay.
Sorry.
Is it better now? Is it audible now? Am I audible now, sir?
Yeah, better.
Yeah. Sir, the previous person's question regarding the order book. So, assuming that the order book we have is of rupees 2 billion, and we expect it to be executed by F27. So, what type of revenue target are we looking at for the next few years, sir? By F27, F28, preferably. Could you talk about that, sir?
Yeah, actually, I know when we said that when I answered the previous question, I told you that most of this order book, depending on the sector and depending on the geography, there are different programs that we are working on, but then I see the maturity happening by FY27. That's what is as per the current indication. Most of the 90% of the order book maturity would happen I would still like to maintain that, given the size of the business which is growing and the order book addition to that, I would still think that, we will continue to grow double the industry growth. If the industry is going to grow by almost 7.5%, 8%, I think that it is very safer to assume that we would grow double that, the thing. Specifically, we are still to work on how much of each of this segment. So we are still working on the numbers from our customers. So we are still not ready with full set of numbers which we may have for the next year. So we will have some more clarity towards the next quarter.
Okay. So just to add on to that, assuming that your two-wheeler industry, your entry-level segment, if this segment, comes back to pre-COVID levels, so what type of revenues are you looking at what type of revenues could you expect for the two-wheeler segment? In FY2023, we did something around 1,000 crores of revenue. And so what type of revenues would you be seeing if the potential of this segment, sir?
No, see, currently our two-wheeler by way of total revenue contributes closer to total two-wheeler revenue contributes almost closer to 1,000 million, till year-to-date revenue. So I would say that, we are expecting a double-digit growth in the two-wheeler segment in the coming year. That is what is the most industry predictions are all also pointing to. Added to that, we have got a good amount of tech-agnostic products that are maturing into the higher end CC, where our contribution per vehicle as well as the margins are better. So looking at that, we should have a very healthy. Again, I would still say if the industry is going to grow by 8-9% in two-wheeler segment, we will double the growth.
That's nice to hear, sir. Just last question. In your opening remarks, you mentioned about this new 4,000-ton press in the plan. So what type of components would you be primarily looking at from this press, and what type of margins or revenue profile? Could you talk about this press line, sir?
Yeah, this is we were all this while our component category predominantly could have been accommodated in a 2,500-ton press. So our lines were equipped to handle that. As we have now moved to higher engine category, going up to almost 18 to 20 liter engines, the components that we have developed for some of our customers, which would include customers like Cummins, JCB, Kohler, Liebherr and CNH programs. All these would require bigger tonnage of press. So we have added this new press. It's a brand new press. Unlike the industry generally, the bigger presses are not added on the thing. So it's a brand new press with fully automated line with anti-vibration mounts and all those features. So this would be operational towards the end of the second quarter, while the commissioning would start towards August. So this is primarily 50% of this capacity would be meant for forging these bigger connecting rods, and 50% of the capacity we still would like to keep it for developing some bigger aluminium components as well. So given the product portfolio and the profile, obviously this would be niche, and I expect that going forward we will have few more of these presses in the future, because there is a lot of traction in this kind of components.
Got it, sir. So basically you would be catering more towards the larger engines from this 4,000-ton press.
It is all for mostly coming into the non-automotive segment, larger engine capacity, larger connecting rods, and bigger components, which is also both steel and aluminium.
Thank you so much, sir. I wish you all the best. That's all from my side.
Thank you, Akshay.
Thank you. A reminder to all participants, you may press star and 1 to ask question. The next question is from the line of Kashif Zaveri from MK Investment Managers. Please go ahead. No, you're not audible.
Yeah. Is this better?
Yes.
Yeah. Thank you so much, sir. And, congratulations for a great set of numbers. I have, 4 questions here. One, in terms of order book, of about 2,040 crores, how much is domestic and exports?
Okay. Yeah. So the order book, domestic, totally segment-wise, if I have to see, the domestic contributes about...
Sorry, your voice is echoing, sir.
Yeah. Domestic contributes about 41.45%, and exports is about 58.55%. Approximately about 1196 million is from exports and 847 million or 846 million is from domestic.
Right. And within this 11960, which is exports, how much is EV?
XEV is about close to 2,000.
2,000. So about 20% of that is, or slightly less than 20% of that is EV.
Yeah.
Okay. Second question is on the operating leverage side. So continuing from what Siddharth had, highlighted about the domestic margins, now at almost about 18%, how much of more operating leverage can be squeezed in the domestic operations from the investments that we have done over past, let's say, about 4-5 years? We have invested almost about 1,100 crores in capacity additions. How much of more operating leverage can be squeezed from this existing capacity?
It's just to correct your my last previous answer, about 2,000 or 200 crores coming from EV in exports, but another 165 from domestic. So you need to add that. Both put together, it's about 365 crores coming from XEV. Just to correct that, because my answer was more towards 200 coming from exports, so I left out the domestic portion there.
Right, sir. Got that. Okay. On the operating leverage side?
The operating leverage will definitely come through as our utilization on the two-wheeler segment improves. We would say about another 0.5% may still come over the next 1.5 years. Okay.
So last time, in one of the conferences that I had met, you had highlighted that on overall basis, we could still do roughly about 18-19% kind of margins. Now, contingent on what is happening in the Swedish operations, would that 18-19% be limited to less than 18% overall on consolidated basis?
I think it is safer to look at that way on a current situation basis because I said that Sweden might take some more time to come back, while we are performing well on our domestic front or Sansera in India basis. So it's safer to assume that for time.
Sure. Third question is on the capex side. We have spent significant amount on capex last 5 years. Next 5 years, we are seeing, the complete, change of our revenue mix in favor of the newer technologies. How much are we going to spend, let's say, over next about 5 years in terms of capacity addition, and how, on a broader basis, I'm not asking, individual business-wise, but on broader way, on the broader scale, how would that capex be split? So, over next about 5-6 years.
See, most of our capacities are going into new technologies only, except that in passenger vehicle, we are looking a lot of traction of in the passenger vehicle. You would see in the coming days, we would or in the next quarter announcement that we are talking to some new big customers, international customers, on addition of business in the auto ICE as well in our core category of components, and it's substantially good business inflow coming from there. So while most of our investments today are focused on tech agnostic components, that is going into aluminium forging, machining, anodizing lines, special process requirements, We are also expanding our capacities in non-automotive segment. That is, as I said, that we are adding capacities both in forging and machining for larger size components which goes into industrial, construction equipment, agri as well. But looking at our order inflows, we should safely assume that because we do end-to-end capacity expansion, about on a gross block level, about 1.5 to 1.6 asset turns is what we should look at in the automotive and non-automotive category, except in aerospace where we could probably look at 1:2. So in that basis, we on the order book basis, that is how we will split our capacity, capex.
Sure. And last question is on, new components contribution to overall top line. What is it today, and over a period of next 5 years, where do we see that going?
Praveen, you want to take it?
See, typically speaking, what Preetham had been telling is that we are likely to grow double the industry growth. From that point of view, 50% of our growth would be coming from the new component and 50% would be via the industry growth. Now, this 50 could be sometimes 60, 65%, sometimes around that. But typically around 50, 55% of the growth would come out of the new products.
Sure. Sounds great, sir. Thank you so much. That's it from my side. Thank you so much, sir.
Thank you.
Thank you. Ladies and gentlemen, in order to ensure that management is able to address questions from all participants in the conference, please limit your questions to 2 questions per participant. Should you have a follow-up question, we request you to rejoin the queue. And the next question is from the line of Mumuksh Mandalesha from Anand Rathi. Please go ahead.
Thank you so much, sir, for the opportunity, and congratulations on a good standalone performance. Sir, can you provide an update on the aluminum forging? What are the revenues currently in 9 months and expected revenues in next few years?
Mumuksh, thank you. See, aluminum as it stands today for the current 9 months, aluminum we have done about close to about pure aluminum components, about 26 crores of our revenue for the first 9 months. But what I see here is we have already achieved closer to, we will be producing closer to 1 million components this year. And this is with current, this whole of this year we worked with almost 2.5 presses. Now we are working with 4 presses. And then 2 more are getting added now, 1,600 and 1,350 ton press towards the end of this year. And looking at how business is shaping up, another 3 presses are required at the current order book that we have confirmed orders. So in terms of aluminium tech agnostic products and aluminium forged and machined category of components, if you see our order breakup, almost 245 crores is coming from tech agnostic components, 12% of our total order book. So there is a good amount of traction, and please understand, except for a few 2 or 3 orders which we have got from passenger vehicle industry, we haven't yet touched that at all. So what we are doing and currently focused on is on premium two-wheeler segment and also on some XEV segment on the scooters. But then there is a huge scope, and currently, as I see, whatever capacities that we have committed and the thing, we are full up to FY25. So we need to,
And that would be 250 crore currently order book, right?
The current order book, which is not yet executed itself, is about 250 crores, while we already have total tech agnostic, I think, order book, if I see, is about 361 crores. Yeah.
Yes, got it, sir. So on the Sweden, can you share what has been the revenue and the PAT for the 9-month numbers? And can you just guide how do you see the for FY25?
So, revenue for 9 months is about 127 crores for Sweden. And we expect to reach about 160 crores for the year. The projection for FY25 will depend on how the negotiation with the customers go. We are looking at multiple options, as Preetham explained. It could be pricing, it could be volume. So it all depends how the negotiations conclude.
But currently, we don't expect too much of a growth coming there for the next year. We expect the revenues to be flattish. The EBITDA margin currently for the YTD stands at around 7.5%. But for the quarter, it was lower. The EBITDA margin for the quarter was only about 1%. So going forward, we expect that from all the things that I told you, that Sweden would still be, while we do not expect from the beginning that we will not cross. I mean, we were targeting about 10% EBITDA margin from this business, but next year would be a challenging year. So we expect that with the current talks with the customers, we would be able to resolve this issue and move towards that number.
Got it, sir. And just lastly, can you share some thoughts on the margins for the new segment like Auto Tech and XEV? So, I mean, it would be broadly similar to the overall company margin, or you will see better margins as they are more on the export side?
Yeah, tech agnostic componency on an overall basis, if I see tech agnostic and XEV components today, more than 50% of that is coming from exports. So which means that the export margins are better in line with our exports margins. But there is also, as I also kept on explaining, especially on tech agnostic components, there is still headroom available for improvements because we are currently in the phase where both development and mass production ramp-up is happening in the current facility, which is again restricted to one of the facilities here, where we do only in one facility. So there is a lot of pressure on while we have to develop all the components, all the improvement cycles are still on the progress. So which means that going forward, we will still have good headroom for improving our margins. We are still not optimized on both machining and forging on this category of components. Potentially, we will do much better on this category.
Understood, sir. Thank you so much for the opportunity.
Thank you. The next question is from the line of Arjun Khanna from Kotak AMC. Please go ahead.
Congratulations on a good set of numbers. I just have a few questions. The first one on the aerospace and defense side, sir. In terms of order book, we talk of almost 185 crores of an order book. So in terms of an annualized number, which year do we expect to hit these peak annual revenues?
I think if I see how things are progressing, the FY26 and FY27 towards the middle of FY27 is when I see the current full order book, full maturity, Arjun.
So by FY27, we could see roughly 185 crores revenues. Is that the right understanding?
No. So this 185 crores of revenue is only on the new order books which are yet to be executed. So
because our FY23 revenue is around 90 crore rupees.
Yes, no, but if you really look at the current order book that we have had, apart from what we have, so this itself would be around 180 to 190 crores. So you add another 185, 190 crores for this order book from the new orders. So, in my opinion, that overall order book from the current orders and the new orders put together would be around 350 to 360 crores.
Oh, okay. Fair, understood now. So we are saying the facility will reach peak utilization by FY27. That's for the entire facility.
Yes. That is how.
Right. And this year you mentioned that some orders, like you mentioned in the previous quarter, have been partly shifted. So on an FY25 basis, what kind of order book would come into the actual execution?
I think FY25, we are looking at somewhere around 170 to 175 crores.
Total
revenue in aerospace.
Sure. So we are looking at possibly 27 being double of 25. Is that the right understanding?
I think so, yes.
Sure. Secondly, sir, if you did talk of winning...
This also goes in line with what I've been saying, that in the next 2-3 years, given the kind of growth potential that is there in the order book visibility, we could grow by 50%. This year being exception because one of the things we had got. So if you really extrapolate what is happening, that is how it will pan out also.
No, that's very good to hear, sir. Sir, the second question is in terms of the two-wheeler piece. You mentioned we have won a number of premium two-wheeler orders. Just wanted to understand, do we utilize the same equipment machining or do we have to set up new equipment, etc. for them?
No, basically, for the existing setup components, category of vehicles, especially on the entry segment and the executive segment of vehicles, we don't intend to, or we have not added any capacities. That is where we use our own existing facilities. But on all the premium models, be it on ICE components as well as on tech-agnostic components, there needs to be a capacity expansion that needs to happen, especially on aluminium components and on higher cc crankshafts, like 400 cc. But very marginal. On the core components, there is no expansion that is planned.
Sure. And just in terms of core components, what is the utilization rate currently?
I think in the last quarter, Praveen?
We had mentioned around 50%.
Around it was last year it was around 55%. I think we have now, this year we are closer to 70% now.
That's right. We are closer, somewhere around 67-68% is on an average. We expect the year to go close to around similar number, 68 to 70%.
Sure. So then that operating leverage should show up in our margins markedly if utilization rates go up further.
Yeah, there is certainly a potential to go further up. We expect the utilization, but as you see that our order book is very strong and we are adding new types of products. So we are adding new lines, new product lines. So our capex will continue to be on a higher side. So maybe only over a period of time we'll have these better operating leverages, but we'll continue to have that benefit.
Sure. Thank you and wishing you all the best.
Thank you, Arjun.
Thank you. The next question is from the line of Rakesh Vyas from Quiz Investment. Please go ahead.
Yeah, hi. Congratulations on good set of numbers. I have two set of questions. First one is extension to what was asked previously. On the existing capacity that we have, what is the peak revenue that we can expect from the business? Because you said we are in the conventional, we are already at around close to 70%. Given the kind of product mix that we have, what is the maximum revenue that we can attain? And the second question is the peak revenue visibility of 4,500 crore kind of number in FY27. How does the existing ramped up order actually gets accounted for? For example, if there is a change in model from the existing OEM, which you are already supplying, how does the reordering or some of those numbers comes into picture in this 4,500 crore revenue?
Yeah, actually, see, our order books, as we have mentioned earlier, we don't take any of the existing business replacements into our order book. So suppose if we are doing just to give you an example, if we are doing some components for a Maruti Brezza, and a Maruti Brezza would get an upgrade, and we get an order for that upgrade model. So our order book does not constitute any of these components. So there is no order which accounts for replacement business of the existing business is accounted for. While we say that there would be some programs which would probably retire, but given the track record of our past performance with the customers and our relationship and the thing, we expect that we would be a strong participant in the future models as well from the existing, because that is how the development cycle goes. We keep ourselves engaged with the customers in the development cycle from the beginning, because our kind of components also go through quite a long time of development, about 1.5 years of development. So to answer to your question, none of the replacement business are factored in. It would be only new businesses that are factored in. Second thing is that you asked me what is the peak revenue potential of our current facility. So while we say that theoretically we would like to have between 80 and 85% utilization, that is given the cyclical nature of our business, we need to keep some headroom for some peaks in the other things. So we are comfortable operating between 80-85%. Please understand, these capacities are calculated on a 3-shift, 300-day working basis. So with that, I think that, and this is a moving piece, we keep adding and depending on different sectors performing, I think it is safer to assume that at around 85%, we can generate a revenue of current capacities about 900 crores per quarter.
Got it, sir. And just for clarity, the existing revenue that we are generating today, which is on most of the ramped up production on the already existing order book, is there a visibility that of this, how much will actually taper off going forward into FY27?
No, please understand that my existing order book or existing revenue is not peaked. It consists of three pieces, if I have to say. One is that it's a full mature business. There is another one which is probably a 50% mature business, and there is a portion of business which is just started last year and on the ramp-up phase. So all these three put together and all have got different things. While we do drop our business plan, we also have take it into consideration depending on the model and customer-wise projections on what model goes down. We keep that into, so there is enough headroom because the current order book is not a full mature order book.
Got it. And lastly, just to clarify again, this 4,500 crore revenue visibility is as of orders that exist in hand today. And in next 2 years, if you get more orders, which you will obviously get, this revenue visibility will actually further improve beyond this 4,500, even for FY27 itself, because as you said, some part of this new order will get to ramp up during FY27 as well.
Yes, that is definitely that is the plan, and that is how we work, because we continuously interact with customers. We strive to participate in all their new programs. We also expand our both geographically and product mix. So we expect that we continue to add new businesses into our order book in the coming quarters.
Great. Thank you so much, and best of luck.
Thank you.
Thank you. The next question is from the line of Kapil Singh from Nomura. Please go ahead.
Yeah, good morning, sir. I had two questions. So firstly, I wanted to check on the technological front, in case of aluminium forging, especially for the new components, what kind of technological skill sets are required to be successful in this business? And, we hear that there are a lot of players who are trying to get into this space. So just, in terms of competitive intensity and margin profile, how how would that play out?
Morning, Kapil. This is a journey that we had started about 3-4 years back, when we realized that our expansion has to happen beyond auto ICE components. So this was something that, and we being in the forging and machine category of components, the obvious choice was to get into something very similar. So when we started our journey, we also said that this is something that we could achieve or do it much faster and much easily. But contrary to our belief that the kind of components that are being offered, at least in the segment that we are operating in, are quite complex in nature, which means that the end-to-end production facilities are required to be in place in order to most of these are Class A and Class B components, which are very, very aesthetically important apart from functional requirements. So, which means that our whole focus currently, which was all on functional and micron, sub-micron level of tolerancing and all that, added to that, a new dimension got added was very, very strict and stringent aesthetic requirements, because most of these products are going into, or majority of these products are going into premium models. So while focus on aluminium forging technology itself was primary the thing, but the material flow, the die hitting technology, the equipment itself, but a lot of vertical integration, both in terms of machining, anodizing, solutionizing, everything is being. So the what is very key here, at least that is what we have learned, is that what you forge is not what the product, that the finish of the product, that is not what you see at the end of the line. So this gets amplified after solutionizing, after anodizing. So it is better or it is recommended that most of our customers should have a fully integrated facility. That is where we are expanding our, today this is what we have learned, and this is how the whole industry operates. And added to that, a lot of skill set is required on product, like some of these components which are, in multiple planes. You would not believe we would have done some 65-70 iteration to get into levels that we are in. So it's something that is not as simple as steel. The equipment and technology is not fully understood and available in India. Of course, there is a lot of interest in this segment. People are wanting to get in, and by having this technology about 3-4 years now, we seem to have got a good head start in this.
Great, sir. Second question I had was, if you look at the model cycles for the OEMs, now they seem to be more aggressive than the past, where a lot of frequent changes are taking place, and more focus is there on premiumization. Now, I suppose that is also going to put a lot of pressure on your development and engineering teams. How are you preparing to handle this, and how does this manifest into profitability for the company if you are putting in more effort to develop these components? And some of these may be running for lesser periods before again there is some kind of upgrade that is coming. If you look at historically, the models used to last much longer.
While of course traditionally what we used to do, or when we have as we keep growing this segment, there is also kind of understanding on the category of this segment. So broadly today we know how there are triple clamps, there are support brackets, all these are Class A components. Now we are able to understand a product category subcategory among this category. So traditionally in Sansera, what we have done is we work with quite advanced software where we do automation on the design itself. So while parameterizing the whole thing, that we automate the design of both product as well as the fixtures and jigs that are required. And we have, when you have seen in our facilities, we have mostly, even in forging, all our toolings, we have made it more, fungible, depending on the thing. So we can actually change from one component to another component quite fast in terms of the thing. But having said that, you are right. The number of components that are developing per vehicle is significantly increased. The number of models and the variants that are getting developed are also increased. There is a lot of pressure. Only thing that is currently challenging is that, and while I say that while we are adding capacities, not much of time we are getting on a lot of improvements that we want to do. So we are adding capacities, and I'm sure that in next 2 to 3 quarters, we would get into a space where we will have some team and equipment to only focus on improvement on the thing. But going forward, this technology that we have now learned over 3-4 years, we will also put in our expertise to automate a lot of design work as well. So that is how we are looking at it.
Sir, my question was also to understand that if there is more development work being put in for these products, is it that you can ask the OEM for better margins also for these products? Because, ultimately, if you have a product A and, it runs for 10 years, 20 years, and now, these products are running for lesser periods and more development work is required, then ideally you should be asking for better margins from the OEM. So that is where I was coming from.
Always we want to have better margins from the OEM. Of course, because these are on the premium category of vehicles, and with a diversified customer base that we have, we expect that the product margins are going to be better in this category. Of course, we also get development cost for these components as well. It's not that we don't. Customers are, they also understand the kind of iterations and kind of development efforts that goes in. So we get compensated for the development cost as well. But over the time, our understanding of the product pricing has also been better. We have also done mistakes in our product pricing in the earlier stages of our development. We have understood it better. We are pricing it more optimally. So, yes, you are right that this category over the maturity should give us better margins.
Thank you, sir. Wish you all the best.
Thank you, Kapil.
Thank you. Due to the time constraint, we will take this as the last question. I now hand the conference over to management for closing comments.
Thank you everyone for for your time and interest in our company. I conclude this call. If you have any further queries, please contact us directly or our SGA, our investor advisors. And thank you again, everyone, for joining us today for our earnings call.
Thank you, everyone.
Thank you.
Thank you. On behalf of Sansera Engineering Limited, that concludes this conference. Thank you for joining us, and you may now disconnect your lines.